Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for August 17th of 2025. Start out with the chart pack this week. Let's talk about tariffs. We've got some data here from Alpine Macro looking at the 2018-2019 tariffs. This is something that we've kind of talked about a lot with clients over the last several months, because we did have an episode a few years back where we did have tariffs that were not quite as onerous or large as the ones we're talking about today, or this year, I should say. And so it's always helpful to go back and look, what was the impact? And we know that we saw kind of a delayed impact, at least on pricing. It took about 6 months for those tariffs back then to have any real measurable impact. And again, I think we're getting caught up in this euphoria of, hey, listen, maybe these tariffs are not having that much of an impact. I think we're just not far enough along to kind of really see that. And that's not to say it's going to happen. It's just say I think we need to give it a little bit more time before we can make any hard and fast conclusions over the impact of these tariffs. But as you can see here, what's really interesting is it did not boost domestic manufacturing, which is the primary goal, or I should say maybe a side saddle goal to political gains and strong arming by our chief executive in some cases. But the stated desire is to increase domestic manufacturing. And you can see here that looking at the 2018 tariffs, it did not actually happen that way. Continuing on with Alpine Macro's data here. Here's a couple of charts. We're looking at construction spending. Upper left chart here, we're kind of looking at real manufacturing construction spending in total. You see that major bubble. We're coming off that peak here. But when you back out computer, electronic, electrical, what we see is about where we were maybe towards the tail end of the pre-pandemic era. We have gained, but not nearly as much as the data centers and all of the technology spending. And obviously you can see that impact down here and the dramatic increase coming after that pandemic, almost a linear rise up here. And as that relates to manufacturing technologies, here we got robot density in manufacturing industries. You can see where China has really taken the lead now. You can see the US in blue is kind of keeping pace with the rest of the industrialized world. But here you can see that we lack and lag, I should say, far behind China's growth rate in the use of robotics in manufacturing. You have tariff revenue. Clearly, I mean, we're seeing a dramatic rise in revenue. I mean, this is meaningful stuff. We're talking about $130 billion, which, when you think of it in the context of a $20+ trillion economy, it doesn't really move the needle that much. But you can see here, as we look at prior years and even going back to the post 2018 tariffs, which would kind of like drive some of this increment here, you can see that what we've experienced year to date has been dramatically higher. Here we have producer price index for freight, looking at it in a lot of different areas. And so we've got truck transport, we've got deep sea transport, and then air, and then rail. So, if we look at these primary components and we go back to kind of this inflection point here in 2022, when we had these rates out there, essentially they've been flat for all intents and purposes for a number of years. And so, maybe if you're trying to draw some conclusions, you got air transport that might be tailing up a little bit, and then you've got rail that might be going up a little bit. But when you really look at it in a box here, and then obviously extrapolate it over 3 years, it really hasn't done that much. Here we have a misery index, and this is presented to us from Liz Ann Saunders at Schwab. And I haven't talked about this. We put it in the chart pack a few times, but really it's just the year-over-year change in the consumer price index plus the unemployment rate. So think of it as inflation plus unemployment. And obviously the higher, the more troublesome you would expect it to be for the economy. And as we look here, it's pretty benign. It's about 6.9. Obviously, it's higher than the average that we saw for the 2015 and 2019. But just to be clear, I mean, from a pure like misery or if it's trying to infer that we're having a lot of stress in the economy because of high inflation and unemployment, you just don't see it here. I mean, obviously, if we go back to 2000, basically 2010, we've got the global financial crisis in here too. It was a lot higher than that on balance. And so, again, one of these kind of conflicting indicators that says, you know what, we're really not that bad off, where other things show a clear slowing. We have some mix in the data, and this is just one of those points. Here we have small business expected credit conditions, and you can see here we're about -4, so it's still looking a little bit tight in terms of credit for small businesses. A lot of banks do want to lend to businesses right now, but they're holding to some pretty considerable standards, considering the uncertainty that exists out there in the economy right now with regard to tariffs and also federal policy. Soybean exports to China, not surprisingly, amidst the trade snafus here, have gone down considerably. Looking at prior years, a fair amount of consistency, perhaps a little bit of a little tick down in 24, but that clearly has decelerated as a result of high tariffs and trade protectionism. Spot shipping rates, we looked at shipping rates before, or shipping volumes, and what we see here is a dramatic drop. So, obviously we're not quite to October. This really kind of spots us at about the 14th of August here, but back in the end of March, before we had the tariff announcements, we're kind of at the same level. And you've got to go back to really 23 and 22 to find spot shipping rates that are any lower than what we've got right now. And you can see here that they've been persistently higher during the intervening periods. Container ship departures, as we've said, with the tariff conditions underway and a lot of the trade uncertainty and also the jawboning and kind of the political posturing on the part of China and the U.S., you can see here volumes are certainly collapsing in a pretty dramatic way. So here we have a couple of data series overlay. We got retail sales in this blue bar. We've got daily shipping into the U.S. We just talked to you about how those shipping container rate, particularly from China, have gone down quite a bit. And there's a rough correlation here. I'm not going to extrapolate. Apollo and Torsten Slot are making the case here that decline in total shipping is pulling consumer spending down. I would say that it has the potential to, because there's a scarcity of goods because of the lack of imports, and we certainly know that our U.S. consumers facilitate negative trade balance because there's so much demand for foreign goods, and with those good shipments dropping, one would expect perhaps that you'd see a decline in retail sales. On this slide, we have investment grade credit growth overlaid against nominal GDP growth. You can see the growth of the investment grade market was robust for a number of years here, and then it slowed when we got down to 2018, 2019. Obviously, in the pandemic, we had negative nominal GDP growth because of the pandemic. You can see that we've had better overall growth. This slide is really as much about the kind of the tepid growth in the investment grade bond market versus really any particular commentary about the state of the economy, which, again, when you bounce back from a recession here, that you're clearly going to have some outsized years. And, you can see here a normalized rate of growth would be something like this. But still clearly, we're struggling to get that investment grade credit market back up to speed. Talked a lot about the so-called hard and the soft data. And here we have a depiction of this from B of A Global Research. And where we are now is that, we've got the soft data, which is looked very strong and then kind of eroded. We're still kind of in that negative territory. There's a hypothetical here with this red arrow that, are we going to see a little fishtail hook up in some of those soft data items? Again, there's been a preponderance of strong hard data, and let's just define these two. Soft data would be surveys, sentiment, things like that. The hard data represents the actual numbers like durable goods orders and shipments and retail sales and the observable data, which by and large has been pretty reasonable. So we've had this disconnect for quite some time between the hard and the soft data, and so far soft data is a little bit soft, and hard data is not catching up with it. So we'll be curious to know where this winds up. But again, I'd say that there's, for every data point that you could find where we're slowing down, there's another data point that says that we're chugging right along. So a quick look at world central bank policy rates. You can see that when we're sitting here in the U.S., it's kind of almost struggling to understand how interest rates are going to move from here. We're looking at the rest of the world and saying, hey, these policy rates have been dropping for some time. So this is obviously putting a lot of pressure on the U.S. Oddly enough, the dollar is still down about 12% year to date, but I think with tariffs and I guess this perceived decline in U.S. exceptionalism, which I'm not necessarily buying, that has something to do with a weak dollar in the face of the central bank policy rates going down overall. But again, this is all kind of putting pressure on the Fed to reduce rates, which I think as we sit here in the middle of August, that there's a pretty reasonable expectation that we're going to get an interest rate cut of some sort next month at the FOMC policy making meeting. U.S. GDP, looking at this relative to its peer group. Here's the U.S. We're looking right here, and then the shaded area represents forecast, and so we're looking for a little bit of softness here in the environment as we exit 2025. Obviously we had a little bit of a bounce back in our GDP last quarter, but it's expected to soften up before getting stronger in 2026. I think most estimates are lining up that 26 is going to be a pretty decent year from a growth standpoint, and then we get into these out years, which honestly you get out into last half of 27, 28, it's really hard to tell what's going to happen. There's systemic issues with regard to our national debt that could come into play, but it's so hard to forecast right now. There's just so many variables. But suffice it to say, weak 25 to end, stronger 26. Here we have deficits as a percent of GDP. This is the other side of the coin from what I was talking about in that last slide with regard to GDP growth, is that we do have an issue that we've got to tackle. And so these are deficits, and you can see going back to the founding fathers, the War of 1812. I mean, this is long standing data, and of course you have only the advent of the Federal Reserve here in kind of 1913, and so after that, you can see that the Fed's job has become increasingly harder as we've gone along, because you've got these fiscal deficits, and then you wind up having the twin deficits because our consumer's strong, which means that we've got fiscal deficits and we also have trade deficits. And where we are now with this, and this isn't something the Fed can control, but it certainly has to react to if it has an impact on the stability of employment or the stability of prices, is the fact that we've got these large deficits. And if you look at the Congressional Budget Office here, they've got their baseline for 2055, and they've got their kind of their alternative scenario, and you've got Moody's that's making a forecast for like 9 years out. And again, these deficits don't appear to be going away. In fact, if anything, they appear to be getting worse. And there's going to be a day of reckoning that we're all going to have to acknowledge that it is coming, where we're going to have some really hard policy decisions made. So a couple comments here on households. This is data that pulled from the chart pack. It was basically Thursday charts out of First Trust here. We've got a composition of household debt, which you can see here is on the rise, but most of that is in mortgage debt. You've got larger size houses, you've got larger mortgages, and whatnot, and you have really stable components from just about everything else. Looking at auto, student loan, home equity revolving, credit card is still roughly steady, but you can see the rise of consumer debt, and this is an aggregate number. So you just got to understand too that the population is also increasing, and we're an aging society that's putting more elderly people out there. And so when you think about the household debt situation, if you look at it on a per capita basis, it looks a lot healthier. But again, this is in aggregate dollars right here. So delinquency and credit quality is something that we've been monitoring very closely as well. You can see that honestly from like 2023, we've been noticing an uptick. And where are the components? Well, 120 days has certainly spiked in 25. But you can see that severely derogatory, interesting term, but severely derogatory continues to kind of remain constant. But it's really when you look at all of these components in total, delinquency rates are increasing. But again, not to a point that we saw in the aftermath of the global financial crisis. We've got aging by various components. So we've got really the big bugaboo here are student loans. And this is, we had a cessation of payments, kind of a moratorium on payments for a while, and then that went away last year, and almost immediately we saw, a rise in 90-day delinquencies. But again, we're looking at credit card delinquencies picking up a little bit. You've got auto loan picking up a little bit, and then you've got mortgage and kind of home equity, housing related delinquencies that are kind of holding steady a little bit. But it's really the revolving stuff. You've got your autos and you've got your credit cards up here, and then those student loans, that is going to continue to remain high, I believe. So here's an interesting chart that really goes to my comments about volatility. And, I've talked a lot about this even back in April. We had a lot of, I did a special perspectives on volatility. And this really speaks to that. So when you have a major drawdown, as in this case defined by the SG trend index, so we're not talking necessarily about the S&P 500 index per se, but you go back to all of these, instances. You got, you got Liberation Day, which honestly we don't know, the aftermath of that quite yet. But it was just taking a look at, the magnitude of the drawdown, and then it's looking at it again 1 year post event, and then 2 years post event, and then the perspective here is you look at early tech bubble in 2000. You've got quant crisis. You've got the Iraq War and the tech bubble recovery in 2002, and Bear Stearns going 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 away basically. And then you've got these other catalysts for these, major drawdowns of, 20% in some cases over here, like, 15, 10%. But the takeaway here is that the trend 1 year later, in all but one, in one scenario here, as the exception, they are all higher, and in some cases dramatically higher in the year after the magnitude of that drawdown. And so this is emphasizes and amplifies my point that you should absolutely be looking to take advantage when markets are sloppy, when volatility is high, and opportunities tend to present themselves at the moments of worst despair. Now we'll slide over and take a look at the markets a little bit here. We've got a comment on really the growth rates and various components of the portfolio. You've had, a rather dramatic 31% rise in cash, even as we've seen 21% rise in holdings of equity and even 20 some odd percent rise in debt. But the largest gainer of all three of these has been cash. And you can see here, as we sit here in August of 2025, that money market fund assets are a record high. And we were saying all along here over the last couple of years that money market assets were rising to new record after new record after new record. And here we are. We've got $7 trillion of cash. And it's just a dramatic growth rate over a number of years here. And it represents a tremendous amount of dry powder in the markets. Okay, so continuing on here and looking at the equity markets, we have the price returns for the S&P 500 looking over the last year. You see we start off August 24th. Dark blue line here is the S&P 500. You can see the impact of the tariff tantrums kind of in this period, and then the ensuing recovery. And you can see, we've had obviously a dramatic recovery from those April lows, and that's the S&P 500. If we look at the S&P 500 equal weight, you can see here that the gain has been far less. So we've had far less breadth in the market lately than history would suggest. And and then here too, if we look at the median S&P 500 stock, I mean that median gain is splitting these two in the middle. That just means that half of the returns are above and half are below. But one of the things that we've just got to all acknowledge is that this is not your father's S&P 500. And as we sit here today, technology is 35% of the market cap of the index. And if you assume that Meta and Google are communications stocks, if you lump them into the technology basket and you add to that, Amazon, which is classified as consumer discretionary, and then Tesla as well, then you get to something that looks a lot closer to like 45% of the overall index has some technology tied to it. And you think about this, and energy, which at times has been 15, 18% of the index, is 3% of the index now. And when you think about everything that's not technology and its influence on the overall market, I mean, you got to dig a little deeper than you used to, and that's why we've seen this dramatic rise. And that's why you're looking at the overall S&P 500, you actually do see more volatility. And lately, it's been volatility on the upside, but it could also be volatility on the downside too. So just some perspective for you on the yearly returns dating back to last summer. So talking about the S&P 500, we certainly have to continue the conversation about volatility. So we did see the spike in volatility in April with the tariff tantrum, but by and large, vol has been very low on the S&P 500 side. And as I've mentioned to you many, many times, we've seen actually a lot more volatility on interest rates. And so that's what's depicted here in the red, you've got the MOVE index. That's the U.S. Treasury implied volatility. And as you can see here clearly, for a number of years now, we've actually had more volatility in the fixed income markets than the equity markets. So we're still talking about volatility here, and you've got volatility that's been seasonalized. And I thought this top-down chart was pretty interesting because it just plots, the average volatility on a month-over-month basis, going all the way back to 1990. You can see that vol tends to decrease during the summer months as people are gone a lot. I think that has a lot to do with it. And then, you get to your problem months, the months that tend to be the worst performers from a monthly standpoint in the market are August, September, and that's when you get that jump in vol that peaks in the October timeframe and then goes down through the end of the year. And this is just making a case that maybe we're not tracking directly to, that long-term average, but this may be fitting a pattern here of more seasonality than anything else. And if you take that in the context of the chart that I had on the last slide, which is that you've got these technology stocks that are 45% of the index that exhibit more volatility. If volatility picks up, guess what's going to happen? You're going to have more vol overall in the market, and it's going to be driven potentially by those high-flying, large technology-tied stocks. And then here's just really another depiction of vol, but it's making the point here that when we see trade market uncertainty, we're not getting that spike in volatility that we did back in April. And so I've been making this comment to clients as well. It's like there was a lot of vol and uncertainty in April, and it did cause a pretty dramatic sell-off. But, in subsequent months, we've heard, jawboning about this tariff or that tariff or extensions on it. No one really knows. There's just kind of a vague uncertainty, but people are not getting all riled up about it. And that's why we have this disconnect here. Gold has been a very interesting and dynamic performer. Here we have the depiction or the overlay of the gold performance line to global equities. And this is not U.S. equities, this is global equities. And this is the astonishing thing, that gold has actually outperformed global equities, particularly over the last decade, but even more so over the last year or so. Something else that we watch is kind of like the quality of the companies in the index. And so we spent a lot of time, talking about the Russell 2000, that we've got a lot of non-earners in the Russell, and that's actually the case here, and it has been for a couple of years. You've got basically about 35% of the Russell 2000 companies in the index don't earn income. They're losing money. Whereas in the S&P 600, which are small caps, that number is down to 9. So this to me helps to kind of frame the quality argument. Like the S&P 500 we know is dominated by the Mag 7 and technology firms, and a lot of those technology firms are extremely richly valued. I mean, Nvidia is 8% of the index, and it trades at basically 20 times sales, not earnings, but sales, which is just it's an insane valuation. But that's the S&P 500. When you deal with small caps, good news here is that most of the small caps actually make money. Russell 2000, totally different story though. We have earnings relative to their trend. We just came out of a quarter in which earnings were, expected to be maybe mid-single digits, and turned out to be at least twice that much. And you can see here, this is kind of a normalized earnings per share, which is moving in a kind of a geographic line. The actual trailing 12-month earnings per share has been tracking well north of that for at least the last couple of years. Some major surprises coming out of these quarters, and the earnings are exceeding expectations. Here we have growth versus value. Suffice it to say that value continues to underperform growth, but over a very long period of time, value tends to outperform growth. It's just that we're seeing with regard to as we've talked about the composition of the index being what it is, you are tending to favor growth right now. And then here we've got value as a factor, investment factor, and value is pretty cheap right now, and certainly on an aggregate, but also a relative basis. A couple interesting charts to kind of close out. We talk about the banking sector a lot and how a lot of the business is moving kind of off channel, so to speak. It's moving to the non-bank sector, which would be like these limited partnerships and private credit that are lending kind of out of the traditional banking channels. And partly due to that, but partly incentivized by it, has been the dramatic decline over time in the number of banks. And you can see, like, when we hit recessions, it really doesn't accelerate the trend that much. It's just that we had like almost 18,000 banks in 1985, and we're down to around 4,000 today. And the last chart here, we've got data center usage. I'm going to be attending the energy conference for the Dallas Fed that's working in conjunction with the Kansas City Fed. That'll take place next month. Really interested. We already know very well that data center investment is going to have to rise, and we know it's rising. We know the capital spending plans on all of these AI firms is going through the roof, and you can see here energy consumption as a share of power demand is expected to essentially double, and from today's levels. You can see here in the headline, we're about 5% now, and by the time we get to 2030, that's going to be twice that much. So a lot of investment in infrastructure spending is going to be happening. Obviously, the rise of data centers, risk crowding out, other necessary and needed sources of demand. So it's just going to place a premium on developing energy sources, whether it be kind of like small footprint nuclear or something else. But we're clearly going to need the power. We're clearly going to need the infrastructure spending, and that's good for the economy. That's all I've got this week. I hope you have a great week. I will be out of town next weekend, but be back in 2 weeks. Have a super start to your coming week. Take care.